Hi friends, hope you are having a fantastic day. This is CA Ushma Jain. Welcome back to my channel. Are you an NRI looking to transfer money from India to your overseas account? Confused between Liberalized Remittance Scheme, that is LRS, and $1 million scheme? In today's video, I'll break it all down. Who can use which scheme? What are the tax implications? And which one is the best for you? Stay tuned till the end. Why NRIs need to repatriate funds? Many NRIs have earnings in India, maybe from rental income, interest income, saving in forms of fixed deposits, sale of securities, or even out of sale of property. Or sometimes NRIs get money as a gift from their relative. These funds they may want to receive or transfer out of India. But how do you legally take this money abroad? There are two main ways. First is LRS, that is Liberalized Remittance Scheme, and second is $1 million scheme. First is LRS, that is Liberalized Remittance Scheme. In reality, Liberalized Remittance Scheme is intended for resident Indians, not for NRIs. Under LRS, a resident Indian can remit up to USD 2,50,000, which is approximately rupees 2 crore per financial year for purposes such as investments, travel, gifts or education abroad. However, since we are discussing fund repatriation by NRIs, let me explain these provisions with NRIs in mind. If an NRI receive a gift from their parent or any other relative as defined under the Indian Income Tax Act, the gift will be exempt from income tax. Now, the resident parent or relative can use their Indian saving accounts to transfer funds directly to the NRI overseas bank accounts through LRS. So, this gift money they can transfer from their saving resident account to their NRI relative in his foreign bank account using LRS scheme. The bank will deduct TCS if the amount exceeds rupees 10 lakh. So, what is this TCS? TCS is tax collection at source, refers to the tax collected by banks on foreign remittance under the Liberalized Remittance Scheme when the amount exceeds a specific threshold. It's not an additional tax on the resident remitter, but rather an advance tax payment that can be adjusted against their total income tax liability when filing the annual income tax return. If the total TCS collected exceeds the final tax liability, the taxpayer, means the resident individual who is transferring money to non-resident, can claim a refund. In cases where there is no tax liability, the entire TCS amount can be refunded. So, it's not an extra burden, it's just you are paying your taxes in advance, which you can adjust at the time of filing your tax return. And this TCS details will be reflected in your Form 26AS, AIS, TIS on Income Tax Portal, which you can use while filing the ITR. I hope it clears the whole LRS concept. LRS is applicable when NRI receive funds in his foreign bank account directly from a resident Indian bank account. Bank deduct TCS for resident Indian, and this TCS can be adjusted with actual income tax liability at the time of filing the tax return by that resident Indian. And I am not diving into specifics like current TCS rates etc., because my focus at this moment is on understanding the methods available for repatriation of funds rather than getting into the finer details. Now let's move to another important aspect, that is what is the $1 million scheme. What if you as an NRI want to send your own money from India abroad? The money could be from rental income, savings, the sale of Indian stocks, mutual funds, property sale etc. There is where this $1 million scheme comes into play. To transfer money under $1 million scheme, an NRI must have an NRO account. You will need to contact your NRO bank and inquire about the documents required to transfer funds abroad under this scheme. Most likely, the bank will ask you to submit Form 15 CACB. Although online sources may mention that Form 15 CACB is only required for specific purposes, but in practice, banks ask for it in all cases as part of their internal due diligence process. If your bank is asking for 15 CACB, you will need to consult a chartered accountant to assist you with these forms. An important point to note here is to ensure that the funds you wish to transfer come from a legitimate source and that all applicable taxes have been paid on these funds. And good news is that under $1 million scheme, there will be no further tax on this transfer of money. Now let's compare these two schemes side by side. LRS is applicable on resident Indians, while $1 million scheme is applicable for NRIs and PIOs. Under LRS is $250,000 per year, while limit of transfer under $1 million scheme is $1 million per year. Purpose for LRS can be gift, investments, education, travel, while under $1 million scheme it will be transfer of own funds from NRO account to NRE or overseas bank account. Under LRS, TCS will be applicable if your amount is crossing the threshold limit. Under $1 million scheme, there is no TCS, no further taxes, but you should have paid taxes on your earnings in India. Under LRS scheme, there is no need for CA certificate. Under $1 million scheme, you may require Form 15 CACB. So, in nutshell, if residents are sending money to an NRI, LRS will be applicable. If NRI is transferring his own money abroad, $1 million scheme will be applicable. I hope this will be helpful as I aim to create videos on topics I encounter daily in my work as an NRI taxation expert. That's all for today. If you are an NRI planning to repatriate funds, make sure you choose the right option. Still have questions? Drop them in the comments or book a consultation. Thanks for watching. See you in my next video. Take care.